top news of the hour is that the DII inflows have crossed the 1 lakh crore mark for the first time amid market decline. Meanwhile, the FIIs continue their selling. This month, the foreign institutional investors have sold about 1.0 lakh crores so far. But to weigh in on the situation, we're joined by Ajay Bagga, who's the market expert. Hi, Mr. Bagga, thank you so much for taking the time out and joining us today. Mr. Bagga, if you look at the numbers, the DII inflows have crossed the 1 lakh crore mark this month, while the FIIs selling has continued and it has reached 1.08 lakh crores, which is now on par with the DII buying. Firstly, what is keeping the faith of the FIIs?
What is keeping the faith of the FIIs?
The DIIs, I beg your pardon.
Yeah. DIIs have pumped in more than $53 billion across the year. Across the year, if you see, nearly about 445,000 crores. So 4.45 lakh crores have been pumped in by DIIs. It's a function of the flows. So right from EPFO to mutual fund SIPs to insurance flows, we are seeing the Indian investors turning bullish on the India growth story. That's a more long-term money that's coming in, and we are seeing that getting allocated. So, at every dip in the market and every time FIs are selling, not only are the DIIs buying, but they have absorbed another about 4.1 lakh crores in terms of promoter selling of 2 lakh crores and another 2.1 lakh crores of IPOs, FPOs, QIPs, PE sales. So all secondary market sales also have been on an uptick. Nearly 2.1 lakh crores of that also has been absorbed by the DIIs. So their motivation is the India growth story, the structural India story, and the long-term money that they have from the Indian retail investors who don't lose heart as the markets correct, as we have seen over the last 4 years. And that cohort of investors in India is only increasing.
So, Mr. Bagga, so basically the DIIs are buying the dips because they believe that India is structurally a strong growth story. But now, since the FII selling and the DII buying is now on par, going ahead, do you see the reversal in the market that is backed by the DII strength, even if the FII response remains lukewarm? And of course, the Q3 and the Q4 earnings are also going to play a big role going ahead. But do you see a reversal backed by the DIIs?
Yeah, it will come. Eventually it will, because these flows, last year we got about 5.4 lakh crores from DIIs. This year we will be slightly lower, about 5.28 to 5.3 lakh crores is what we are estimating. So slightly lower than 2023 calendar flows. But you must see also the kind of challenges that DIIs have faced, and still they have been investors in the market. So it's the Indian retail investor, largely the Indian pension money and insurance money, which has been holding up our markets. Does that reverse? I think it keeps on increasing. So the DII flows will keep on increasing. When does the FI flow reverse? I think a time will come. Right now, the dollar has been on a tear up. The US yields have been going up on a very strong US economy. So we have to see more Fed rate cuts and a slowing US economy when the EMs will come back in favor, and then you will see the Indian market recovering. So that's a global macro. On the Indian scenario, we will see as the valuations become more compelling. And how will that happen? We are expecting half two of this year. So October 1 onwards, we are expecting earnings to start growing again. We are expecting government spending to really pick up. Today, the government expenditure and fiscal deficit numbers that have come out, it's really showing the impact of the elections and then the floods, that the government has not been able to allocate the budgeted expenditure into the economy. We are expecting a sharp uptick in that in these 6 months from October 1 to March 31st. And that will have a multiplier effect coming in the economy. Earnings should recover fast. So on a 1240 to 1260 rupee EPS of Nifty by March 2026, you will see a re-rating happening. And that's what will see FIs also returning when they find that India has become a fairly valued high growth story. That's when the FIs return.
You answered the question of when will the FIIs come back home, but of late we have been witnessing sharp correction in the market, and it's been going on for a while. The earnings season has been a dampener, especially with regards to valuations, which is now a concern, especially with regards to the underwhelming earnings season. Is the earnings season likely to get better in quarter 3 and quarter 4, and therefore also aid the valuations that we are posed at?
Yeah, absolutely. I mean, you hit it on the hit the nail on the head. Basically, earnings have been a drag. The first quarter was largely because of lack of government expenditure, uncertainty around the elections, and then as the results came in, the budget came in, we lost a quarter. Then the second quarter allocations were really happening, and then there was a monsoon which was pretty severe in large portions of India. So you see the cement companies, the auto companies, two-wheeler companies, a big dampener there. And then we have seen some pockets of credit risk emerging, especially in the microfinance, on the unsecured lending by NBFCs as well as banks. We have seen provision coverage ratios increasing. So these were some pockets which have not done so well. FMCG was expecting that by the second quarter demand would come back. That has got postponed into this quarter. So I would agree with you that the second half earnings should see a pickup, and then we should see a strong pickup into the next year. That got postponed because of the national elections and the allocation of the government being underwhelming. That allocation is now coming in these 6 months. It will start showing results, and that will lead to a pickup. But I would agree, private consumption remains an area of concern. You need some counter-cyclical measures on the fiscal and monetary side. Those have been lacking right now. We are expecting fiscal measures to come in now in these 6 months. Monetary, let's see when RBI comes in. They've moved to neutral. They have to move to more accommodative now. When that policy change happens and we see a rate cut, I think we'll have to wait till February for that.
Bagga, you mentioned consumption and demand, which is also again a pain point. As far as the rural demand is concerned, we have already started to see green shoots, but the urban demand, urban consumption has moderated, and that's a point of concern. Besides, of course, the underwhelming earning season. Now you spoke about how the earnings could pick up, but speaking of the consumption and the demand, do you see that picking up as far as the urban demand is concerned? Now that we have already seen the rural demand gradually picking up.
Yeah, urban demand has grown at about 4.5% year on year. That's hardly beating the inflation. And the big point there is one, petrol, diesel prices have not been cut, even though the government has seen the crude oil prices going down quite substantially. So clearly there was there was an opportunity to cut. Then a very key food materials like say edible oils saw a 20% import duty coming in. That goes across the FMCG chain. Wherever palm oil and other vegetable oils are used, we have seen that inflation coming in. So we are seeing a constraint on demand in the urban areas. How will that get resolved? One is the government expenditure coming in. Private capex in certain areas, we have seen that coming through. These two will be the drivers, and we are looking at FMCG as a contrarian bet because it's a sector which has not performed for 3-4 years now, and the valuations have come down. It's under-owned. Nobody's really giving a chance for demand recovery. It's a good time to get into FMCG, and there are very quality names, MNC names as well, available right now at depressed kind of pricing. That is the key call, I would say, along with the private sector and top-end public sector banks. I think the two sectors that can be looked at would be the banks and the FMCG sector.
All right, the banks and the FMCG sector is where you see value, Mr. Bagga. But on that note, thank you so much for taking the time out and joining us today, and wishing you a very happy Diwali.
Same to you. Thank you.
Thank you.
If you like this video, then like, share and subscribe to ET Now.